Hello, my name is Katie Wantoch, Agriculture Agent for UW-Madison Division of Extension in Dunn County. Today we're going to be talking about working with your lender. Low commodity prices and increasing debt levels are placing some farmers in serious financial distress. This video series will discuss how you can work with your lender, from learning about the 6 C's of credit that a lender may consider during your loan application, to identifying steps to complete your loan application and establish a relationship with your lender. Lenders will collect financial statements and determine ratios and measurements that allow them to understand the strengths and weaknesses of a farm and to benchmark them with other farms in their peer group. Liquidity measurements look at the upper portion of the balance sheet and is concerned with the farm's capacity to generate sufficient cash flow to meet its financial obligations as they come due. Current ratio is calculated by dividing current assets, which is cash and other assets that you will convert to cash, by current liabilities, which includes bills that need to be paid. Current ratio greater than 2.0 is considered strong, while 1.3 to 2.0 would fall in the caution range, and less than 1.3 would be vulnerable. The greater the ratio, the more money available to quickly pay bills. Working capital is not a ratio, but is a measurement of dollars, and is calculated by subtracting total current liabilities from total current assets. Positive working capital is desirable. Lenders want to know if current assets would pay off current liabilities if your business is liquidated. Lenders will also review solvency, which measures the business's ability to withstand adversity. It is referred to as the ability to pay off all debts if the business was liquidated or sold. Leverage ratio, also known as the debt-to-equity ratio, is the measure of the farm's total obligations to creditors as a percent of the equity capital provided by the owners, or owner's equity, calculated by dividing total liabilities by equity. Can also be said that for every $1 of equity you have, there is X dollars that you owe other creditors. Debt-to-equity ratio less than 0.43 is considered strong, while 0.43 to 1.5 would fall in the caution range, and greater than 1.5 would be vulnerable. Another solvency ratio is debt to asset, which is calculated by dividing total liabilities by total assets. Another way of saying this is that for every $1 of assets that you have X cents worth of debt. Debt to asset ratio less than 30% is considered strong, while 30% to 60% would fall in the caution range, and greater than 60% would be vulnerable. The higher the debt to asset ratio, the more risk that the lender may be taking on. Lenders will consider these questions: how much of the value of the assets is owed to creditors? How leveraged is the business? Profitability measures the business' long-term survivability from operations and is the primary goal of all businesses. Net farm income is your measurement of farm profits. Income, the money generated from activities of the business, less expenses, the cost of resources used or consumed by activities of the business. An income statement may be used to measure profitability for the past accounting period. Operating profit margin is the measure of operating efficiency of the business. It indicates average percentage operating profit margin per dollar of farm production and measures how effectively you are controlling operating expenses relative to the value of output. Operating profit margin greater than 25% is considered strong. Between 15 and 25% is in the caution range, and less than 15% is considered vulnerable. Low prices, high operating expenses, or production issues are all possible causes of low operating profit margin. Profitability ratios can be used to assess the financial health of the business. The return on assets, or ROA, is what is being earned on total capital investment or return on the average dollar invested in the business. ROA can be compared to other investments, such as stocks or CDs. ROA greater than 8% is considered strong, between 4 and 8% is in the caution range, and less than 4% is considered vulnerable. Return on equity, or ROE, is what is being earned by the capital invested, or the return to farm equity employed in the farm business. Also can be set as how much you are earning on what you invest in the business. ROE greater than 10% is thought to be strong, while between 3 and 10% is in the caution range, and less than 3% is considered vulnerable. Repayment capacity measures relate to the cash generated by the business relative to the debt obligations. Term debt coverage ratio assesses the ability of the firm to service all debt payments. A ratio of 1 indicates payments could be met, but with little cash to spare. A ratio greater than 1 indicates to the lender that payment could be made and there is room for additional loan payments. Capital debt replacement margin is the amount of money remaining after all operating expenses, taxes, family living, and debt payments have been accounted for. In essence, it is the cash generated by the farm business that is available for financing the purchase of capital replacements, such as machinery and equipment. If term debt coverage ratio is greater than 1.0, then capital debt replacement margin is positive. The greater the number, the greater ability you have to cash flow capital investments. Financial efficiency ratios show what percent of gross farm revenue went to pay interest, operating expenses, and depreciation, and how much was left for net farm income. These 4 efficiency measurements can be thought of as pieces of the same pie and reflect the distribution of gross income. When added together, they will always equal 100%. Interest expense ratio is calculated as interest expense divided by income. How much income is going to pay interest? Operating expense ratio is calculated as expenses less interest divided by income. How much of the income is used for operating expenses? You could say, I had gross income of X amount. Where did it all go? The biggest share likely went to pay operating expenses, depreciation, maybe interest, and then the remaining balance is net farm income from operations. How much farm income is left over to pay for family living and capital expenses?